Hey, Kari.
Hey all.
Scary here.
Trying to boost the volume here on my computer. I turned it down for something else and now I can't hear anything. That's better, I think. Oh, Cully, how did you get a name like Cully?
My real name is Walter Carl Huestis III. So that was a mouthful. So they actually because of the Walter Carl Huestis II, they didn't want to call me Walter. So they ended up calling me baby till I was a year and a half old. So and then my grandfather went to Norway and met a Cully over there and he brought it home, started calling me that, and I've been Cully ever since.
Oh, well, it's
So
better than baby. I mean, it'd be kind of goofy to call you baby now.
child that didn't have a name for a while there. How have you
So,
been?
all right. So since you're a last minute substitution, I just want to let you know what typically people show up a little bit after 5. I'm going to do about 5 minutes on a market update, and then the floor will be yours.
Perfect. So and I have a presentation, so you'll have to give me control if possible. Is that
Oh, yeah, I
doable?
can allow that. Now we do have a little bit of a sort of a Godzilla movie from the 40s happening with you.
Uh-oh.
We hear your audio and then your lips move later. Maybe it's only on my screen.
I can check my connection and see if it's. I can see you're right. It is delayed. Hmm. Let me see if I can work on that.
I wouldn't even know how to fix it. So
Is that true for everybody? I don't think so.
no, your lips and your audio are the visual and the audio are matching, Gary. Does anybody have any requests for speakers for next month and the months after? Take it there's a resounding no. Okay.
Jerry, I'm going to switch my camera and see if it's just the camera that I'm using that's making it delayed. Oh, is
No, now they match.
that better? Yeah, it is the
Yeah,
camera.
now
Okay.
your lips and your
Except for I
audio.
got a little bit of a God complex with my light here. Hold on
Well, made you look kind of holy.
one second. All right, let's move everything around here.
Christy, how many did we end up with registered? Wondering if I should start or wait a little bit.
Carrie, we have 40 responses.
40?
Yes.
Wow. Okay.
Yeah, but usually only half of the responses attends the meeting.
Okay. Gary's here twice. Gary Alexander. Now he's once.
So when I tried to start the meeting or connect to the meeting, it wanted me to update the Zoom software,
Oh,
which
lovely.
surprised me. So we may have some others that are trying to get, waiting for their software to update before they can join.
Okay. Well, I guess I can start with the market update. And we can see who shows up, right?
I think there are 13 participants.
Yeah, we had 40 register.
Okay.
So, and usually, like Christy said, 40 people register and 20 will show up. So, I will share my screen. Oh, that's not it. Stop share. I apologize. Technical difficulties. I'll go here. Use this version. And are you seeing it full screen or
It's quite large. Right now, I'm seeing U2 as a small image.
yeah, but are you seeing kind of it in the middle or are you seeing the full, is it running the full screen there?
It is actually also showing the other slides in your deck.
Okay, let's see. I have another monitor plugged in, so maybe that's, now it's full screen, isn't it?
Yes, it is.
Okay. All right. I got to move your heads now. I'm going completely the wrong direction. Oh. So again, everything I'm about to show you, with the exception of the interest rates. Christy, can you let the people in, please, that are in the waiting room?
I'm on it.
Okay, everything that I'm about to show you except interest rates is data that is strictly duplexes, triplexes, and fourplexes in Minneapolis and St. Paul and the surrounding areas. Okay, so there's no single family, there's no townhouse, none of that is part of this. I don't know if you can see right here, we've had a little bit of a drop in interest rates. Anecdotally speaking, of course, your interest rate is completely contingent on your credit score, and various debt to income ratio, all of that. I have anecdotally heard of people getting qualified in the sixes, and I even had somebody tell me they were at like 5.875 last week. So things are moving in the right direction. This is a 15-year fixed. Even bigger drop. They never got as high, but you can see that they've made quite a bit of progress here. And that's especially important, not only for housing, but especially for duplexes. I met with a gentleman earlier today who I met with him early spring last year, and his property could easily sustain a price that was $50,000 higher than what it can sustain now because of interest rates. Because it's more expensive to own the property, and of course we can't pass that cost difference on to tenants. We can't go in and just randomly raise rates, you know, $700 a month across. His was a fourplex, so we're kind of at the mercy of what interest rates are a little bit. So now here's my favorite slide. This is for the Twin Cities area. So this is just the cities of Minneapolis and just the city of St. Paul, only those two cities. This demonstrates that the duplex market, with, again, we go over this every month, with the exception of February every year, it's relatively constant in terms of sales. The red line is the sales or closed listings. The blue line is active inventory. So you can see every spring we have a whole rush of inventory. Everybody I want to sell in the spring as a duplex, but we don't see kind of a corresponding spike in these sales here. Now, if you're thinking of selling, now last year we had less inventory than we've had in ages. So I'm kind of anticipating that we'll have a bigger wave maybe than even these years here, simply because we're lacking inventory here. Having said that, if you can't get your duplex ready until May or June, you can't get your duplex ready till May or June. Properties still sell. They sell all year round. It's just that you're going to have more competition and you're probably not going to get away with as much, right? You might actually have to put mulch in the flower beds, right? Whereas if you get out now, March, you're going to get away with not having to do that. Okay, just an example. Here's the same data for the 7-county metro area. So this includes Minneapolis, St. Paul. 7 counties for the MLS are Hennepin, Ramsey, Dakota, Washington, Anoka, Carver, Scott is kind of an MLS district. And the numbers are pretty much the same, but we're going to get to a slide here at the end where it's it was an epiphany for me. Here are the number of active listings. So the blue is Minneapolis, St. Paul, and the red is the 7-county metro area. Pretty similar, a little bit slightly higher, you know, when you lump in those other counties, but most of the small multifamily inventory is inside the cities of Minneapolis and St. Paul. So there wouldn't be that much of a spike outside of that. Same with sold listings. Now in January, we had 38 in Minneapolis and St. Paul and 62 in the 7-county metro area. And I thought that was interesting to me. It's not double, but pretty close. Here we go with the percentage of active listings in those areas that actually sold. 27% in Minneapolis and St. Paul, 38% in the 7-county metro area. It's important to remember that there's a lag time usually between a property getting an offer and it closing. So when we look at these numbers, these plummets in January or February, know that that's a result of some activity that happened in December or late November, in all likelihood. So it's not a cause for panic. It's just that some people were distracted. Here we have the average sale price. Note this right here. The average sale price in the 7-county metro area in January was $403,272. In Minneapolis and St. Paul, it was $375, $823. But you can see for much of the year, there was that disparity in values. I think some of that is that there just isn't as much inventory outside those cities, but it was of note to me because I'm suddenly hearing once again some concerns about the city council, and certainly if you didn't read it, there's a link in my blog post yesterday. There's an interview in Finance and Commerce magazine with the city council president for the city of St. Paul. And while she danced carefully around rent control in the interview, she did talk about vacancy decontrol. And for those of you who love your tenants and don't like to do turnovers anymore, if you own in St. Paul, listen now. When that policy was first enacted, they had no such thing as vacancy decontrol. So if you didn't raise rent because you're a nice guy and you didn't want to have to paint or clean a refrigerator or any of that, you couldn't raise rent if that tenant moved out, died, anything like that. You could raise it 3%, that was it. And a lot of you, not anybody in this group, but a lot of owners, market rent might be $1,600, but they're charging $900 because they don't want that tenant to move. And if this council president seemed predisposed to trying to get vacancy decontrol removed. So the initial rent control policy had no vacancy decontrol. So if you were at $900 a month, you could get $927. Then it was modified a year later so that if somebody vacated, you could raise the rent. She's talking about taking it back the other way. If there's no opportunity for somebody to raise the rent and it comes time for you to sell, that $300, $400, $500 a month could literally cost you tens of thousands of dollars. I don't know how to be more clear than that. If you can't get the rent to market rate, try and get closer. It will pay off for you in the end. All right, I'll stop lecturing, but I care about you guys and you work hard, and I don't want you to get stung because somebody doesn't understand that you did it out of the kindness of your hearts. That just makes me so mad. But anyway, okay, onward. So days on market is an indication of how the real estate market is moving. We're not at 17 days like we were in June of 2022 when things, interest rates were like 3%, but we're at 32 days. So between a property going on the market and it pending, it's 32 days. It's probably faster than that to get an offer because this includes time for an inspection, things like that. Property doesn't pend until an inspection contingency has been lifted. Now, we realtors have a clever little trick that we use to help properties that have been sitting a while look fresh. We will cancel the listing, keep it off the MLS 24 hours and put it back on the MLS, and that helps bump it to the top of the list and go out to everybody's email again. Well, the MLS caught on to this and said, okay, we're going to have days on the market. Then we're going to have cumulative days on the market. So they're going to add the first time we were on the market plus the days we're on the market now. So this is a more true reflection of how long it's taking to sell properties. And if you remember, June of 2022 was 17 days, but the reality was 23. And over here, I think we're roughly the same. So just a little insider info. Of course, a seller's market is anything 5 months supply of inventory and below. That means if no new listings came on the market today, we would be sold out of inventory in 5 months or less. The 7-county metro area is very much a seller's market still, not like it was in December of 2022 or July, August of last year. We've got a little bit more inventory for buyers to choose from, but look at this blue line, which is Minneapolis and St. Paul. And to me, this is probably reflective of some of that rent control or new city council fear that's out there. We're concerned. It's just a guess. I don't have facts, but that's my hunch based on the conversations I'm having with property owners all over the metro. So this is the number of showings, right? You can't have sales if people aren't looking at properties. The red line is the 7-county metro area. Oh, that is a big number, Christy. I don't think that's right. I don't think we had 1.6 million last week or last month. So you can see here.
No, Carrie, it's the previous 2 months. I'm sorry. It's just it looks like it's connected, but it's 1,622 and 1,602.
Perfect. Great. Thanks for chiming in there. And then in Minneapolis and St. Paul, we had 1,210 showings. So there's still activity out there. And if you look back, that's, December, January of last year, December, January of the year before. And these stats are through the end of the month. So, oops, one more slide, and then we're going to let Cully take over. So this is the number of showings by price point. The blue line is all duplexes for $400,000 and under. I got to move your heads here so I can see my own. Here we go. The red line is 400 to 499. The purple is 500 to basically 700. The darker red line is 7 to 9, and then the green line is 9 and above. Oops. And you can see the lower the price, the more the showings. If you go above $900,000, there's only 6 showings per month in properties at that price point. So the more expensive you are, the fewer showings you're going to have. The bulk of the market right now is under $400,000, but that's probably always been true. So, any questions? If we don't have any questions, I will introduce our guest. We had a last-minute pivot. The agent that we were having come, why is this my head here, or the chick here? I don't know. All right, I'll just keep talking. You can look at my logo. The agent we were gonna have come called me at about 2 o'clock this afternoon. And he said, I don't know what I was thinking, the insurance agent. He said, there's a guy in our office who owns rental property himself, and he knows all the ins and outs about owning rental property and getting insurance for it and the loopholes. So Cully is jumping in last minute, and you do have a presentation. Am I right? Why don't you tell everybody where you're from?
I do, and that's actually part of the presentation. If I could share my screen, that's a possibility.
I think I made it. I think I made it so you can. Yeah, multiple
see.
participants. Yeah.
All right.
And while he's
Everybody-
doing that, I'm just gonna quickly say, you can find this Zoom call on Housing Providers for a Better Minneapolis and St. Paul on that Facebook group, or on my YouTube channel, Duplex Chick. We won't post anything that's, sometimes we have candidates for office and hotter button issues here. We won't post those videos there because of the experiences we've all had, but for insurance, we'll put it there. All right, Cully, take over.
Wonderful. Well, Carrie, thank you very much for having me. This is a great opportunity to hopefully I can answer a lot of questions and kind of shed some light on a very interesting insurance market that we are in right now in terms of obviously with duplexes and multifamily stuff, but also with personal homes and a lot of that. But we're going to touch, it's about a 15-minute presentation. We'll touch on a lot of things. And then I want to leave a lot of time for questions because I know those usually are going to be plentiful and we can answer anything you have there. So I'll just get going here. So really quick about me, I've been in the industry for 21 years. This is my third what's called hard market, and hard markets are when insurers don't really want to insure things. They're really stringent on underwriting and things like that. So the reason I point that out, kind of like a good realtor, it's good to have people that have been through these types of things and have dealt with it and kind of know the ins and out of what happens when insurance companies don't want to write insurance or are very stringent on that kind of stuff. So I've worked for both captive and independent agencies. I owned my own American Family for 5 years, and then I moved over to Hatzung Insurance 4 years ago, which is an independent agency in St. Louis Park, third generation owner. We represent 15 companies now. We just brought one on, which gives us a little more variety in things we can do just because we're, certain companies like certain risks, have certain appetites. And this way we can really kind of take our client, put them where they need to be and with the company that, matches up well with them. So I live in Eden Prairie with my wife, 2 sons, 8 and 11. When I am not in the insurance agency, which isn't often, I coach and I referee hockey and I try to golf in my spare time, but game has gotten pretty bad over the years. So let's get going. So what I'm going to talk about kind of is what the 5 mistakes to avoid with rental property insurance. I can kind of go through the things that I've seen a lot of people get caught with, things that have screwed up claims, and kind of just things to keep in mind. And then, as I said, we'll definitely take questions and answer any of those at the end. So first, insuring the entity correctly. We see this a lot with agents that haven't done it a lot or just starting to insure rental properties and things like that, where we might have a rental property that's in the name of an LLC or trust owned by the parents, is on a contract for deed, those types of things. And even though that the entity that owns the property isn't the individual, the insurance agent still puts the name into the as on the policy as the individual. And realistically, that's not how you should do that because the individual doesn't own that property. So now obviously every property is different, but the point being is that your agent needs to identify who is the actual owner of that property and get them on there correctly. Reason being is that insurance companies are what they are. And if they can wiggle out of a claim for a legal reason, like we don't have the correct entity on the policy, not spelled correctly, all that kind of stuff, they'll do it. So being detailed at this point is very actually important. Other things that we really do need to take into account, owner occupied versus tenant. Do you live in half of the duplex and then have a tenant in the other half? That's insured completely differently than if you have 2 tenants in there. Is the unit vacant right now? That's a really big one because it voids coverage because they're going to ask that question on the application. Is somebody living in that property? If they are not, you know, we have to take that to a whole different company until that actually is going to be occupied. So do you have family living there? You know, I've ran into that a lot where somebody will own it and then they'll have the, you know, son and daughter living in the unit too. So all of these kind of things are just nuances where we have to tweak the policy or write a different type of policy, but we have to know about it. So you want to make sure your agent's asking the right questions to make sure you're set up correctly. So, and the other thing to note, there are a lot of exclusions on policies. There's tons of them actually. Dogs, businesses, you know, I've got a couple of those where I've had people running businesses out of the garages. Wood roofs have now become mostly uninsurable. So in most of, I mean, we can still get insurance, but it's not usually going to be with your major carriers anymore. Unique constructions. I had one with geodesic dome that they're trying to rent out. That was an interesting one. Nobody wanted to touch that. So, and then also I put on your housing systems because what we're running into with, I mentioned a hard market, is that underwriting is getting really stringent on things like when was the heat, when was the furnace updated, you know, when was the roof updated, do we have updated electrical, and when, you know, I'm not talking about knob and tube here, I'm talking about like, have they updated the electrical in the last 20 years? Those types of things are now coming into play, which they weren't a big deal in the past because companies were so much more apt to write business. Now they're just getting really, really picky. Um, so so that's just kind of the first thing, is just making sure we're insuring the property correctly when we're doing it. Moving on to the second, and you guys know this too, and your realtors are going to point this out, but know what you are buying. So when I say buying the insurance nightmare, I had one where they had nomenclature throughout the house, and it was purchased and whatnot, and they couldn't find insurance to save their life. They ended up having to go to what's called the E&S market to get insurance, and the cost was astronomical. I'm saying, you know, $600-700 a month for just a regular policy. But when we get into these, what I call insurance nightmares, where you've got either knob and tube, manufactured homes are a big one. Companies don't want to touch those anymore. Certain electrical panels that are older, and there's a list of them that literally, if they're in there, nobody's going to want to touch them. The big one we're seeing now, unrepaired prior losses. And this is tough because it's tough for buyers to know if there was a claim on a property that was paid but not fixed. And that's what we're talking about here, is somebody took a hail loss on a roof. Okay, and then they took the initial payment, didn't fix the roof, and then sell the property. Okay, now you go to buy it, they look at the insurance history and they see a claim, but they don't see a permit matching up that the roof was replaced. We have an issue there now. Okay, well, they want to make sure all those repairs are replaced, or you're going to have to get that roof inspected to make sure that it's adequate enough to their standards. So, unacceptable roofs are the other one. Like I said, wood shake, avoid them like crazy. 3 tabs are starting to become untouchable because they're too expensive for the roofers to line up the little tabs. I know that sounds crazy, but this is the market we're in. Dog exposures. Obviously, I don't know who lets dogs on their properties and whatnot. But if you do, there's a list of 7 dogs where if you allow your tenants to have them, then we're not going to be able to write the policy. And those are going to be your Akitas, your I can't think of any pit bulls, in those types of things. There is going to be a law changing that coming up where we're not going to be able to exclude dog stuff anymore, but I don't know when that's actually going to go into effect. So,
I don't think it passed the state. I blogged about this recently. I don't think it
Okay.
passed this Minnesota State Legislature last year, but I
Okay.
know the American Kennel Club is working hard to get it passed in each state.
Okay. Yep. So that's going to change that whole coverage when that all goes through, if it does. But for now, there's still exclusions for certain animals. And if you need a list of those, there's like 9 of them, and it's the ones you're thinking. It's the pit bulls, the Rottweilers, Chows, Akitas, German Shepherds. Boy, I can almost name them all now. But there's a list of them there. Pre-1900 construction, and we're seeing this a lot too. And this is where we're running into those systems that just aren't updated, foundation issues, that kind of stuff. But we also run into I'll touch on this a little in another slide, but replacement cost issues because of how expensive it is to rebuild a home from 1900, because we give replacement cost. And if you want to have, especially in Minneapolis, when you have some of those older homes that have all that beautiful woodwork and all that kind of stuff, we have to promise to replace that. And if they want, old growth redwood put in there and whatnot, we actually have to do that. So the replacement cost of the home is going up extremely high for these older homes. There is ways to get around that, but your agent needs to know what they're doing. So homes currently under construction, this is a tough one because I know a lot of people purchase a home and then go to build it. But if you got something that actually is in the midst of, like, let's say they started a project and they didn't finish it and it's technically still under construction, that can also be an exclusion issue. So, and then the last one, which has always been an issue, is solid fuel heating. If you've got wood stoves or if you have, wood stoves in the outbuildings or anything like that, that's always going to be an issue with the insurance company, just because you've got a live fire in the house. And especially on a non-owner occupied dwelling, you're going to have issues with that too. So one of the bigger mistakes we see a lot as well is just under-insuring the property. And this usually comes from agents trying to keep the price down, which is obviously we want to give you a good value, but the easiest way for them to do that is literally to take away coverage. Now, what we see a lot, and what when I look at these policies, is we see agents that they'll get the purchase price contract or the amount that the home's be, and they'll just insure it for that if they used to do that in the past. So, like I said, with those older houses and things like that, your purchase price and your replacement cost are two completely different numbers. I've had people buy that pre-1900 house for $250,000, and then our replacement cost be over $600,000 because of how old the construction is and things like that. So there are places to obviously save money and whatnot, but be very careful on when you're getting policies if you're just looking at the premium, because agents have the power to manipulate these things and to make them look really good on the price wise, but they're taking stuff away on the back end that you might not know about. So the other thing, a lot of agents that don't do a lot of duplexes and fourplexes, they don't include things like multiple kitchens, multiple bathrooms, 2 sets of systems, 2 HVAC systems, those types of things. So we get undervalued properties where there's not enough coverage if there's a loss to actually rebuild them. So one of the biggest we also see is not realizing what additional coverages are available on your policies. Water sewer backup's been one that's been around for a while. And we always recommend that because it's one of the most common losses in Minnesota, especially in the spring. But 2 that are relatively new and are extremely important, especially in the Minneapolis area and some of these older houses, buried utility line coverage. And this is going to be what sewer line coverage is what we're really looking at, but it covers all utility lines coming into the home under the ground. But when we have older like clay pipes, things like that are prone to frost heaves, collapse, root penetration, all that kind of stuff, you can now get that coverage on your homeowner's policy or on your dwelling fire's policy. So, and it's a lot better paying us $39 a year to get that coverage than it is trying to replace a $10,000 pipe.
Well, and I just have to say that I have been recommending to my sellers, because so much of the duplex and triplex and fourplex inventory in the Twin Cities is in Minneapolis and St. Paul. So it does have those older clay pipes. Even if you don't put it on now, if you're thinking about selling, put it on your property, because if it's crumbled, I mean, who sticks a camera down there, right? Unless you have to. It can be a $10,000 to $15,000 repair. So sometimes just spending that $39, even if you don't use it, can end up saving you a lot of money. So it's a good idea to put it in place. Doug and Cully shared that in my meeting, maybe 4 months ago.
Yeah.
And I think every agent in the office is telling our clients the same thing. That's money well spent if you have a problem.
Yeah.
So.
And the nice thing about these is their endorsements on the policy, but they don't count against you for surcharge for the premium. So if you make that claim, you're not going to see your premium increase because of it.
Does the coverage for the sewer lines kick in only with failure, or does there have to be some kind of a event that caused it? I mean, just because they're old, I was denied coverage because they said it was old.
It shouldn't have been because like we need to have a covered peril. So there needs to be a root penetration, there needs to be collapse. It can't just be because it's wear and tear and it's old and whatnot, or if there's a sewage blockage or something. But if the pipe itself is compromised, that's when this coverage should kick in. Now, obviously, every every policy is written differently, and I can't speak for the entire industry. So it's good to look at like a policy specimen to say, hey, this is what's covered. But most, your agent should be able to explain kind of that what that coverage will be with each different carrier, if you will.
If the
So-
city sends you a letter and says they ran a camera down a line and they said yours is deteriorating, you don't have to replace it right now, but we're gonna put a lien on or a note on your property value saying your pipe may fail. Does that count?
That does not, because we haven't had a loss yet, but I would definitely recommend the coverage if they're telling you it's deteriorated at that point. So, but no, just the fact that it's starting to get bad doesn't kick in the coverage. There would have to be an event that actually triggers it. So, does that make sense?
Okay,
The other one that we're seeing a lot more of is actually called equipment breakdown. And this is sudden or accidental losses to furnaces, AC units, all of those types of systems within the home actually can now be covered. I've purchased, our companies have bought 5 different furnaces this year for different clients. So it's a very weird coverage because it excludes wear and tear. But if you have a sudden loss to an AC unit, a heater, those types of things, that can actually be now claimed on your homeowner's insurance, and they'll buy you new furnaces and AC units. And I didn't believe it at first because I thought they were just going to say everything was wear and tear and it doesn't count, but it actually has kicked in multiple times for us. It's one of those coverages where you got to read the fine print, but it is out there. So it's something we do recommend, because if you've got especially older furnaces, it can save you a ton of money. So just for time wise, I'm going to keep moving on, but I'll answer any other questions you have too. Just know that if you undervalue or underinsure your home, like let's say your home, just for round numbers, should be, or the duplex should be insured for $100,000 and you insure it for $75,000. You're now 25% below. As soon as you go below 80%, there is a massive penalty when it comes to claim time. Okay, so this is how insurance companies penalize you for not insuring your home or your duplex for enough and not technically paying enough premium. So just be very careful, because if you're underinsuring it too far, they're going to get you come claim time, and it reduces the claim payout dramatically, and it's just not fun to get in there either. So, and then last thing is, there's always, policies do include dwelling replacement cost coverage, and it's, you can actually get, if your dwelling is insured for $100,000, you can put this on and it actually bumps up that coverage to 100. It's usually 120%. So 20% above your dwelling coverage. It gives us a little buffer, just to make sure that there is coverage if the cost to rebuild does exceed what we were thinking too. So, any questions on any of that right away?
did you say that you only have to be within 80% of replacement in your?
The companies are going to require at the time of issue that you insure to 100% of replacement cost. Okay. What they're saying is that if replacement cost, if your coverage doesn't keep up with the actual replacement cost, and at some point you are insuring for less than 80% of the actual value, there's a penalty out there when you do that. So all it is, you don't want to set and forget these policies. There's something you want to review every single year, just to say, hey, is building costs gone up? Do we need to, up this coverage, or is it where it needs to be? I've had circumstances where we need to reduce coverage because it's overinsured. It's just something we just want to make sure that what we're insuring it for is what they're really close to what it's actually going to cost to rebuild. So does that make sense?
Can I give you an example? Say your coverage was, insured value was 450 replacement cost.
Okay.
The loss was 500. Are you saying the 500 would be covered because it's within 80% of actual loss?
Nope. This is just saying that if you don't insure the property to the proper amount, they're going to penalize you for that. It doesn't have anything. And how they penalize you. This is about the most confusing part of insurance, is called the co-insurance penalty. But all they're saying is, hey, if you're not insuring your home to what you should, and you're trying to save premium by doing that, we're not going to pay you full claim payout if you're not going to pay us the full premium. So they're going to penalize you if you don't insure it up to the value, or at least within 20% of it. Yeah, go ahead. I see somebody raising a hand.
Yeah, can you hear me?
Yes.
Okay. I'm in a situation where I almost, I don't think I have any control over what I value my property at because my lot is worth a lot of money. I live on the Mississippi River.
Okay.
If something happened to my house, I mean, I don't want to insure this property, like $800,000, but it's kind of like I have no choice because they won't let me go for less. If something happened to my house, I could replace this house for probably 4. The value of this property is in the land, not the building.
Mhm.
And I have not been able to break through that. They won't let me insure it for less than what, the assessed tax value is. So listening to you, it sounds like there is actually a situation where you can undervalue your property. And I've never been able to do that. I want to do that actually, because I don't want to build another house like the one I have now if something happened. So
Tax
is
assessed
that a hard,
value.
is that a hard and fast rule in insurance that you have to, I mean, it's what the insurance agent thinks it's valued at?
Well, I mean, we have systems and we have something called a replacement cost calculator. And that, we put in all the specs on the house, square footage, what is year built, all that kind of stuff. And it will tell us what a builder will charge you tomorrow to rebuild that home. It does exclude the land value because we can't burn that down. We don't need to worry about that. I mean, there's very few instances where the land's going to make any effect at all. And market value and replacement cost of the dwelling are two completely different numbers and actually shouldn't factor together on your insurance policy. The insurance company only cares what it costs to rebuild that house or the dwelling. The land doesn't mean anything to us.
I was told that they have to insure me to the level of an exact replacement.
Yes.
And I don't want to replace it exactly. And you know what? I'm not going to take up any more of your time, but this is really, I do not understand. And this has happened not with one insurance company, but 2. So I guess my hands are tied, but I'm paying a really astronomical premium and I'm trying to get it down, even with a high deductible. But anyway, listen, thanks so much.
I'll have
You-
my contact info. If you want
Yeah.
to go into more detail on this, I can
Yeah.
definitely walk you through it.
Yeah,
So
thank you so much.
yeah, no problem.
Well, and Jean, I know where you are. I know where your duplex is, and it's worth more than you think.
That's the other thing is the cost to replace.
Badly. I mean, it's a good thing.
I know, Carrie, but if it burned, well, first of all, it's brick, so probably the structure is gonna be pretty. But I mean, if I wanted to just build a charming little cottage and not a duplex, I'm not able to do that because they want me to spend, $700,000, $800,000 on the rebuild, and I don't want to do that, and yet I have no control over it. They're making me do that. They're making me spend that much money. That's what I don't understand. You'd think they'd, appreciate that I want lesser insurance, but no. Yeah,
A lot of times it's the contract that says we have to replace the dwelling to how it was originally. So, and if we are on that contract like that, then we have to go up to that amount because you could ask us to do that, after a time of loss. So I don't love how they write the contracts. I just interpret them. But no, if you ever want me to go into more detail, we
Great.
can definitely walk through
Thank
it.
you.
Yeah, no problem. So
And I have what I think will be a quick clarifying question. So
Yeah.
thank you. So is dwelling replacement cost coverage, is that different than my regular insurance coverage for my duplex? Is that a different amount?
I should have I put this together in a hurry. It should have said extended dwelling replacement cost
Oh,
coverage.
okay.
And it's just that 20% that goes above your normal amount of coverage to, I mean, like the cost of materials and labor right now is out of control. It's coming back to reality, but it's still high. We can't predict what's going to happen in the future. So that's a buffer to give us the ability to rebuild the house if we need to.
And that would be an extra clause in the insurance policy that I could request.
Yep, it's an endorsement. It doesn't cost much to do, but it's always something I recommend it to everybody because I obviously can't tell you what it's going to cost to rebuild your house, the unit 8 months from now.
Yeah, good. Thank you.
Yeah, no problem. All right. This is one we don't see a lot either. Is loss of rents coverage. This is an important one too. So because if you lose your dwelling, the insurance company's on the hook to replace your lost rental income. Okay. Now, how it happened. I mean, like when I go do a dwelling fire policy, it just throws in 10% of the coverage of the dwelling coverage as, you know, your loss of rents coverage. Your agent should be asking you how much you're at stake to lose. You know, if you have a quadplex, that's a lot of rental income that you could lose if you lose that building in a massive fire. So we can adjust these policies or this loss of rents. It's literally the fifth line on the policy. But it's one of those things where everybody just kind of goes with what the system tells them to do. Where you really do want to have that conversation of, hey, you know, I have $180,000 worth of rent in this quadplex. If this thing burns down, how long am I going to get that back? So the other thing I always advise is look at your current policy. A lot of older policies were written with time limits in them, either 6, 12, 18, 24 months. I don't know if anybody here's tried to build anything lately, but it's kind of hard. So finding contractors, finding materials, especially when you throw an insurance company in there trying to, you know, working with you as well, it could get really long to actually get things rebuilt. So make sure that you're looking at your loss of rents coverage just to make sure that you got at least, I recommend 18 months of coverage, because that's what we've seen a couple things take to rebuild. But just don't take the minimums there. It doesn't cost a lot to increase that either. But it's one of those things where if you lose the home, you want to make sure you continue to get paid for it while it's being rebuilt. So then not knowing your policy. This is one too that you've got to be very careful with, because the insurance industry has been changing policies upon renewals, and they put the notices with the policy, but nobody ever reads them. So many policies have now changed from replacement cost roof coverage to what's called actual cash value, where we're taking into account depreciation. That's a major coverage change, and it's happening all over the place. How they're doing it, they're not announcing it. They're putting a little slip inside your renewal paperwork saying, hey, your coverage has changed, and you now don't have replacement cost. So nobody likes to read their renewals, but it's actually good to look at some of those little pamphlets that they're in, inserts that they put in there, because that's how they kind of tell you what's going on, or have your agent actually read it and tell you what has changed over the renewal. So because if you are going from replacement cost roof to actual cash value, and that roof is 15, 20 years old, you might only get 50% of the value. Okay. Roof costs $20,000. You get all of a sudden now you've got a $10,000 bill plus your deductible to replace the roof, where before it might have been $1,000. So be careful on what they're doing with these policies and read your policies. Okay. Because especially on the dwelling fires, we are seeing some companies make these changes. So exclusions, there's been some of those added. Well, the other one we're seeing is forced deductibles, where you might have had $1,000 deductible before. Now you might be seeing a 1 or 2%. That's of the dwelling coverage. So if you have a $500,000 dwelling, you now have a $5,000 deductible. So just if it's 2%, that's a $10,000 deductible. And I don't mean to be doom and gloom, but this is just where we're at. And like I said, the companies that you work with can make a big difference. Some of them are not doing this, some of them are. So just make sure you're reading your policy. Then I just said, don't get blinded by the cash flow, or the premium. I know you want to save as much as you can. You don't want to pay more, but just make sure you've got the right policy in place for the dwelling you have. So really quickly, right now, be very careful remarketing your properties. Some of you are going to have grandfathered coverages on those policies you have that aren't available anymore. Okay. Be very careful if you're marketing. Like if you're just saving a couple $100, most likely not worth moving. So, but if you're getting non-renewed, which some of you might see, or some other things like that, that's the only time you really want to be moving at this point. Give it another year. 2025 should be a lot better. We're going to see a lot more companies opening up their doors and start writing policies again. For those of you that have multiple properties, if they're in this, there's ways to save money. Multiple properties in the same entity, those can be put on the same policy. You don't have to have individual policies. You get benefits like a common loss deductible if they both get hit by the same storm. You only have one deductible. Shared coverages like liability, things like that can reduce off premium. The only thing that can run into is you might have issues with escrow and billing if you've got multiple mortgage companies, but that's kind of in the weeds. And we can explain that to you too. So the other thing I always tell people, tell us the truth, the whole truth, and nothing but the truth, and tell us upfront. Hiding stuff, the insurance companies have gotten very good at finding stuff. Okay. telling upfront what's going on with the property, what's there, what's bad about it is what we want to hear. Because we have companies that do different things and don't have, have different appetites. We can't help you unless you tell us what's going on up front. Okay, hiding it, yes. I know there used to be a practice where it's like, oh, if we don't tell the insurance company, they won't find out. They will. And when they do, now we're seeing, 60-day cancels. And all of a sudden, you write a new policy, it gets canceled after 60 days because they find something they didn't know about. Try to go back to your old company, they won't let you because they don't want it anymore either. And then you find yourself in an insurance nightmare. So just be very upfront with your agents. Okay. That's one of my biggest things. But it's not gonna, it's one of those things where we can help you. It's not gonna be one where we like hang up the phone at that point or anything like that. And then obviously require renters insurance. And I require your tenants to have at least $500,000. So liability, we've seen that a lot. And if you're not requiring renters insurance, start to do so immediately. So I think I've taken up almost all the time. That was my last slide. The insurance industry, they've lost money for the last 5 years. Last year, they paid out $172 in claims for every $100 they collected in homeowners insurance. That's a ton. They're losing billions over the last 4 years. The only two states that are worse to insure in than Minnesota right now, California and Florida. And we're followed closely by Colorado. But it is a really tough insurance market right now. We're seeing rate increases anywhere from 12-35%. We're seeing changes in coverages, mostly roof coverages is what you're going to see. Their replacement cost on roofs is going to go away. Slowly but surely, it's going to be gone. Probably within the next 5 to 7 years, that coverage won't even exist anymore. It's all going to go to actual cash value, just how your cars are paid out, that kind of thing. So expect that. You're going to see minimum wind hail deductibles. Those are going to continue being put on policies, 1%, 2%, or a lot of companies are going to $2,500 flat deductibles. And like I said, I have 4 companies right now that aren't writing any policies in Minnesota and aren't sure they're going to in 2025 either. It's just
I know why, because Doug shared it at our meeting, but can you explain why Minnesota is in such rare air?
There's multiple issues going on, but the biggest one is our hail exposure. So there's just there was so much cost that was associated with even the 8/11 storm that came through. That was $1 billion loss. And that was the one that went right down 394, right down Golden Valley and ended up in St. Paul. That we lost $1 billion over that 4-hour period. So those losses are substantial now, and the cost to do these roofs and how much roofers are charging and whatnot has just pushed the insurance companies to the brink of they're just losing money hand over fist, and they're correcting the ship now so they can stay viable and actually have money to pay claims. So I don't know if that's the same explanation Doug gave, but there's multiple things going on. There really are. And it's just a lot of factors all hitting us at once. And I say us as the insurance companies. So
now I can say that I had a listing where it was multiple offers, and the winning buyer wrote an offer without an inspection. And the buyer I represented the seller, having trouble getting an insurance policy because they had not done an inspection. And the insurance company required a 4-point inspection.
Yep.
So explain that a little bit, and then what the end run is.
Yeah, so that's with one of our carriers. Actually, I know the exact carrier it is. But if the home is over 50 years of age, okay, so they now require that any home over 50 years of age is going to need a signed letter from an HVAC, a electrician, a plumber. What's the system I'm missing? HVAC, plumber, and a roofer.
Electrical?
Yep.
A roofer.
All 4 of them have to say that their home is in or the systems are in correct condition and adequate for the risk. So you literally, for that carrier, if it's over 50 years old, they want you to go out and find 4 professionals to come in and actually certify the home. So that's how picky they're getting out there. So that's why I said changing carriers, and this is, as a person who provides insurance policies, probably shoot myself in the foot. But right now I tell most people, don't leave, stay where if you're in a good situation, I'll be the first person to actually tell you that, because I know that if I take you out of a good situation and I aren't able to put you in a better one, it puts you in a peril. So a lot of times our best advice is not to do anything at this point. So Carrie, did that answer your question?
Yeah. And what makes you think 2025 is going to be better? Are you
the amount of
psychic?
No, they're showing with the amount of rate increases that they've taken, it's been substantial. I mean, if you guys have homeowners
Yeah.
policies, you've seen them go up probably 40% over the last 2 years, if not even more. That amount of premium should balance out what their losses are. And once they become profitable again, they'll start entering the market. So we get another couple of hailstorms and it could be even worse till 2026 or later. So what we're really scared of is a Florida situation where big carriers start pulling out and just don't insure here. And that's been rumored. So that's scary. So that's my presentation. I got plenty of time. If people have questions or if I didn't answer anything or if you need clarity on anything, let me know and I'll give you my contact info too here if you have any individual questions you want to do offline.
Jean's got a question.
Yeah.
Oh yeah, go ahead.
Kind of a comment. I mean, I think your point is really well taken, to be completely honest. Always, it's a good policy, right?
Yeah.
Because it seemed like, we've sealed our own fate. Like I sense that there's a lot of fraud that's been going on with these roofs, because I know people that don't really have damage. And there are people going door to door asking, we'll file your claim for you. We can do all of this. We can get you a new roof. And so people are just getting new roofs, whether or not they really need them. And somehow that is, bypassed an insurance inspection, or, in some cases, the insurance companies are just so overwhelmed by these hail claims. They're just like, okay, just replace the roof. But I mean, I feel like there's been a lot of that isn't really necessary. And,
Yes. My boss's brother had 3 roofs put on in a span of 2 years. So, and it was the same thing. It was just roofer after roofer kept knocking on the door. You got damage. Yeah, and it's happened. So the other, I said there's a couple exclusions being added. What you're also going to see is what's called soft metal exclusions on the roofs. Because what used to happen is the venting, the aluminum venting and the whirly birds and things that spin, when those had damage, you couldn't replace those without pulling off part of the roof and whatnot. And once you pulled off part of the roof, then they had to replace the whole roof. So you might only have a $30 piece of aluminum that was damaged by hail. But as soon as we had to pull that off the roof, we had to replace the whole roof at that point. And, a $30 piece ended up being an $18,000 roof. So we're going to get rid of the home insurance companies being in the home maintenance business, because everybody's just been waiting for, wait for a hailstorm and they'll replace your roof then. That's going away. And then the frivolous claims are going to get eliminated too. So, and it's unfortunate because we shot ourselves in the foot just over claiming asphalt shingle replacements. So without a doubt, they're correct.
The insurance company, those cheap aluminum things or whatever they are, should be re-engineered. That should be mandated to be re-engineered, so you don't have to tear up the whole roof to replace them. But yeah,
I agree.
I don't run the show, so unfortunately.
Yep.
So,
Thank you.
yeah, and I have another question, that you may or may not be the right person, Cully, to answer, but, I don't have a tenant who has asked this, but I have another friend who's a tenant where there's Freon gas occurring in the house. And, my friend says the landlord won't do anything about it. And I wondered if there's an insurance aspect to that. Like, is there coverage for something like, not Freon, but the one we have all the.
You're talking radon? Like a radon?
Well, Freon is what he said.
I bet you it's radon. Because
Yeah.
if it's a radon gas, I mean, Freon, I don't think it's toxic. That's just what keeps the air conditioning cold. I don't know that.
Okay.
But
Yeah.
radon would be the one you're talking about where it could cause cancer and that kind of stuff.
Yeah,
So,
he could easily have gotten the word wrong. So let's assume
fortunately,
it's
in
radon.
that case, we don't have, and I hate denying stuff, but you don't have a peril there that would trigger an insurance claim. Okay. So you don't have a flood or a busted pipe or anything like that. It's a natural thing. But yeah, that's one where you definitely would like them to remediate it if possible. But unfortunately, the insurance policy is not going to be the one you go to for it.
Yeah. Okay, great. Thanks.
Oh, I do have one quick question about
Yeah.
renters insurance.
Yes.
If you're in an owner occupied duplex, you still have to have your tenant have 500,000 K in liability, or, 500,000 in liability insurance? I mean,
I would. I mean, we're talking about, here's my thing. A renter's policy, like if you're living in half or you're owner occupied in half, then you got a tenant in the other half. It's about $120, $130 renter's policy with a $500,000 limit. So I mean, we're not talking about a lot of money, but if they cause some action that burns down the house and that kind of stuff, yeah, your policy is going to cover rebuilding that, but you're going to want to have a recourse. Or if they, do something, I mean, you never know what a tenant's going to do. They don't own the place. It's just better to cover you. The other thing with like multi-units, when you've got, like if you got one renter that, let's say you got a fourplex, one renter starts a fire on purpose and burns down the other four. Now you got to have, there's a whole bunch of aspects where that person's liable for a whole lot of stuff, the other people's personal property and all that kind of stuff. You just want to make sure that they have limits adequate to
Okay.
take care of that, if
Thank
it makes
you.
sense. It's just for how little it costs, it's so worth it.
And you think of that in terms of the tenant paying that 120 or whatever a year.
Yeah, I would
I
I
just-
would require them to do it. Don't pay it for them.
I
Yeah.
just thought the premium would be a lot higher than that amount, like 150 or whatever. The premium would be a lot higher for that high of a liability, but apparently not.
Liability is actually really inexpensive. Their
Okay.
personal property is what pushes that policy up.
Okay.
But no,
Okay,
if it's just a $10,000 worth of, personal property coverage for what they have in the unit, and then $500,000, it's really inexpensive. So,
Okay,
correct, yeah. Sound good?
yes.
Perfect. My contact info is there. Karia also has it. So if you ever need anything, let me know. And I don't have to be your agent to advise you either. If you just have an insurance question and you can't reach somebody, I can answer it usually, or at least find the answer for you. So, but I appreciate all of your time. So good luck out there in the insurance market. It's kind of a beast right now.
Thank you so much for jumping in. This was
Yeah,
great.
no problem whatsoever. It's been great.
Yeah, so helpful. Thanks.
Now, any other questions for anybody? And if not, we will convene next month and I will come up with somebody else for us to talk to. All
Okay,
right.
thank you, Cully.
You're welcome.
Yeah, thank all
You're
of you.
thinking Cully, not Kari, so.
Perfect. Well, have a great evening, everybody.
All right. Thanks, guys. And if you want to rewatch this, it's going to be on Housing Providers for a Better Minneapolis and St. Paul Facebook group or the Duplex Chick YouTube channel. It's not very fancy, but the recording will be there.
Thank you.
All right. Have a great evening.
Thanks.